This is a video where I'm going to talk about what we think is going to happen next. It's quite serious what I'm going to talk about, and I think quite a lot of people probably won't like this message, but it's really important that people understand it, and that's my motivation in sharing it. I think hardly anyone really has understood what's about to happen, and I've looked into it in a lot of detail, and I'm pretty confident I know what happens next. I can't say for sure, but I can certainly identify some major risks that I think are probabilities that people don't seem to be aware of and definitely aren't priced into markets. So broadly speaking, I think we're coming to the end of a giant cycle, and I think our monetary system is going to have to change. I think that process of change is going to be extremely painful. I think there's going to be major transfers of wealth from people who are lucky enough or smart enough or whatever enough to be on the right side of it. And I think there are going to be some significant losers from this. Some of the principles I'm going to talk about hopefully will give you a better chance to be on the right side. And I've got high confidence that what I'm about to say is correct. So the philosophy that we use, we are really risk managers. So, we invest money for individuals across the UK. And I'm not running a hedge fund. I'm not trying to get people rich quick and take lots of risk. I try and outperform other funds by 1.5% to 2.5% a year. And I do that because we're pretty humble and we know we might be wrong. So I'm really confident what I'm going to talk to you about, actually. But at the same time, I'm not running a hedge fund. So despite my confidence, we're not going all in on any of this. But still, we'll do enough to make sure that we neutralise the risks for people at a minimum. We've performed very well as a company with our portfolios the last 5.5 years, but we're changing tack quite significantly. And that gives you an idea about how seriously I take this. So in the big picture, what I think is happening is I think we're going from a mega cycle, let's call it. So a monetary system that was set up after the Second World War and has been successfully deployed from that time. We've gone through cycles, but there have been cycles within that system. I think that's going to come to an end. I don't know what will replace it, but it's going to come to an end in the way all of these cycles do. Basically, we'll run out of road. We have too much debt. Central banks are going to run out of room for manoeuvre. And if you look carefully enough, you can see that's already happened. And I think this is going to unfold in the next 6 months to 3 years. So it's pretty important that people understand it quickly. So if you want a bit of background on it, I'll start with central banks, and I'll try and keep it as simple as I can, whilst explaining it in a way which deals with it properly. So a long time ago, 20 years ago, central banks were pretty much independent of investment markets. So they set short-term interest rates to try and control inflation. They would do other things behind the scenes, but that's basically the main thing that the investment markets were interested in. And the bond market then decided what it thought of it, and bond prices went up and bond prices went down. The stock market decided what it thought, and similarly that the price of that adjusted. Now, after 65 years of the global financial system, the global financial crisis came along because we had too much debt. So we pushed this process as far as we could. And at that time, central banks correctly decided that they had to take much more aggressive action, and interest rates weren't enough. If they just relied on interest rates, we'd have had a depression. It's unacceptable in westernized democracies to allow depressions to happen. So significant action was taken, and effectively the central banks took over the bond market, and they took over the price of the bond market, and it was no longer independently priced. So, most people don't think much about that, but it was a very significant move. If you go back in history, it has happened before, but it hadn't happened in the last 65 years. Now, at the time, they promised they would unwind that. They tried to do it in the US in small amounts last year. The asset markets reacted very aggressively to it. They had to unwind the unwinding. They're never going to unwind it. Now, what's happened now with COVID is budget deficits have exploded in countries around the world. Now, before that was happening, actually, central banks, especially in the US, have pretty much given up selling bonds to external investors, and the central bank has started creating money, and bonds were effectively created from printed money. Now, that process has been accelerated hugely by the COVID crisis. So there are 50% of people in the US who don't have any savings. 50%, quite a significant figure in a democracy. There is no chance of a depression being allowed to happen there when any of the decision makers have tools. So there's going to be an awful lot of money printing in the next few years, unprecedented in recent times. We could have 75% of GDP being created over that period, depending on how the economy goes. I mean, an enormous figure. And it's going to have a big impact on the value of dollars and pounds and other currencies, the impact on inflation and the impacts on your investments. And I'll talk about that in a second. Before I go on to that, I want to just explain a little bit more about some of the trends that are happening in the world. And then I'll wrap all of this up and I'll explain what happens to investments and what that means for you. So in the big picture, we've had major deflationary trends that have been happening. And they've really kept inflation. So we're all used to a low inflation world. As you can tell, I think that's changing. Technology, making things cheaper and cheaper all the time. We've had an aging population. As people get older, they spend less on certain things, and that's deflationary. Of course, we had asset price problems, things like housing price corrections. They're all deflationary. We've had lots of immigration into Western countries, increasing the labour force. That was deflationary. But the big one was internationalisation, so hyper-global liberalised trade. And I've actually been really very much in favour of that until quite recently, and my eyes have been opened, and now I think it's been a tragic mistake in the way it's been done. So really, when we're talking about it, we really mean the entry of China to the World Trade Organization in 2001. So that single event opened up 1.4 billion people to the global labour market. It's an enormous shock. And of course, it's not a shock like a tidal wave that comes over in a month, because they've got to build factories. Places that previously had factories have to close factories. It's a long, slow draining away. But over the last 20 years, effectively the West has transferred its manufacturing base to China and enriched China. It did that because it believed China would become more Western over time and we'd have mutually beneficial trade where both sides benefited. Neither of those things have happened. Actually, China's engaged in industrial scale, state-sponsored intellectual property theft. They've become more authoritarian over time. I won't list all the things that they've been doing internally, but I'm sure you're aware of it. And they're starting to flex their muscles very aggressively internationally, threatening Britain, Australia, the United States, Taiwan. They recently had a conflict at the border with India. If you don't look at China and see a major geopolitical rival, then frankly, you're not paying attention. The entire US political establishment is united around the need to end reliance on China, reverse globalization. I'm certain, certainly other Anglo-Saxon economies are going to do it, and I think most of the world do. The period of hyper-globalization is finished. We're going to start onshoring. That's a major deflationary trend which is about to reverse, and it's reversing for reasons that are so important politically. There isn't much choice, and China is driving that agenda. So we've got the biggest deflationary trends going to be reversing at the same time as governments are forced to start printing money to finance expenditure to avoid a depression. This is going to change the balance, supply and demand for money, and effectively the value of money. Now, I'm really pretty confident we're going to have a lot more inflation, and it will erode the value of cash and erode the value of bonds. And it may even erode it to the extent where people no longer consider it to be a great store of value. We can't say that at this point, but what we can say is the risks are very high. So if you're out there and you're a low risk investor and you're in cash and you're in bonds, and that's what you feel comfortable with because you don't like risk, my upsetting message for you is you can't avoid risk. Risk is coming for you, and you just need to be aware of why it's going to happen. And there are things I think you can do to mitigate it, not to gamble, just to neutralize that risk. But it's really, really important. Please don't sit there with money in Northern Rock, whatever the modern equivalent is, thinking that it's okay, because actually you could see a major destruction in your wealth. The second thing is more geeky and maybe of less interest to most people listening to this, but within the stock market there have been incredible divergences in performance within the market. So different types of company, the gap that's opened up between certain type of company that we would call quality, technical term, you know, the most loved, the most admired companies, and the companies that we would call value, the boring, the staid, the old-fashioned companies, they always exist in the market. And quite often quality companies today, not often always, they're tomorrow's value companies. So there's a constant process of renewal. Now, the gap between those two types of companies has never been bigger in 100 years. Certainly very close to all-time highs. These things always, in my experience, always go back to the averages. It's extremely dangerous, in my view, to be in the wrong kind of stock market investment. Unfortunately, the passive investments that we've participated in very happily for the last 5.5 years, they're really overexposed to those kind of companies. And I think you need to be careful. And again, what I would say is anyone who's extrapolating the last 20, 40, 60 years, 80 years, they're making a mistake, because the environment that drove those trends, I believe, is about to change very dramatically. And the way it's going to change is actually quite unclear. But I think you can balance the probabilities and say we are likely to have inflation and we're likely to have change of leadership within the stock market. Now, what I would say to you is, I'm sure many of you are listening to this and really not enjoying it. Some of you may not even agree with me. But what I would say is I've done a lot of research in it. I've 26 years in the markets. I've never seen anything like this. I'm not someone who, look back at my history, I don't make these calls. I'm not someone who makes a living out of shock tactics and telling people that they need to make changes. I'm a cautious, careful, middle of the road kind of person. I like to avoid mistakes. I'm saying this because I've researched it, I understand it, and I'm convinced something like this is going to happen. Now, as an investor, I think the correct reaction here is not to think gleefully, well, this is a chance to get rich. I think it's about trying to neutralize the risks, that's all. So if inflation runs away, make sure you've got the approach in place that you can maintain the real value of your investments. And I think most people won't get that right. In the stock market, make sure you're not overexposed to certain types of company, because again, the returns from them are probably going to be very poor over the next 10 years. So the whole thing needs a refresh, a new look. Don't extrapolate past trends. If you've got any questions, I'm very happy to answer them. You can just email me directly at Flying Colours. We will be posting other content where we talk about it. But what I would just say, the final message I'd leave you with is that the trends that we've been used to, I don't believe we can rely on them. We can't copy what's been successful in the past and apply it now with any confidence. It's a world full of risk, and I think there will be significant differences, winners and losers, and wealth transfer between people who employ different strategies. Thank you.